In general, yeah. So credit card, plastic card, you guys have all seen them. They entitle the holder to make purchases and pay for them later via a line of credit. Now, there is a difference between a credit card, a charge card, and a debit card that has a Visa logo on it. Okay, we'll talk about charge cards too in this section, but a credit card gives you a line of credit. That is your spending limit or your maximum. Your credit limit is based on your credit history, both like your FICO score as well as your history with the company. So, for example, if you open a brand new account, say like a brand new Visa card, you may start out with like a low spending limit, $300 or $400, but then over time, as you have a strong history with them, they will increase your limit. Because the more money you spend with them, the higher interest they're earning. Same percent, but $300 times 20% is much different than, $1,000 times 20%. So the higher your limit is and the closer you are to your limit, the more money they make. So as long as you're making your monthly payments on time, over time they will increase your limit.
Just a credit card?
Yeah. Now, if you're not making your payments on time, that's a different story.
What does this say? Does it say M general?
In general, yes.
Oh,
In general, yeah. Okay, so your line of credit is the maximum money that you can spend on that card. Now, that is not your maximum balance necessarily, because if you hit your spending limit, you still get charged interest and maybe if you're not paying on time, late fees and stuff, so you can go over owing them an amount. It's not like they cap it out and say your limit's 300, so you can never owe us more than 300. That's not the case. That's just the most you can spend. Impulse buying. We're all guilty of this. You go in the store and you need socks. Okay, I'm going to go buy socks. I need socks. I'm getting socks. That's all I'm buying. I'm getting socks. And you go to the checkout counter and you're like, I'm getting socks and a Twix bar and some gum and a Coke. Okay. Right? I mean, you didn't plan to buy any of these things. You went in the store and you went, ooh, shiny. And you got distracted and you bought it, right? Credit cards have greatly increased people doing this because you don't have to have the money necessarily right up front to pay for the thing that caught your fancy when you didn't mean to buy it, right? You're sitting on television late at night and an infomercial for that hairdryer attachment that spins your hair into perfect curls comes on and you're sleep deprived and you go, I have to have that. And you pull out your Visa and you call them up and you order 5 of them because you're out of your mind. You don't need 5. But this happens because of credit cards. Now here's my advice to you. Okay? Before you buy anything with a credit card, think about, do I want to pay interest on this thing? Okay? I have seen people buy fast food with their credit card. Yeah, do you really want to pay interest on McDonald's? No. It wasn't worth the $5 you were spending to begin with, right? I mean, it's garbage. You don't want to pay interest on it. You have to ask yourself, is this thing worth paying more for it than it even costs? That spinny blow dryer thing is probably not. I don't know if it works or not, but I'm just saying. Okay, but I'm just saying, like, it's not worth paying interest on. It's a plastic tub that hooks to the. I could take a Tupperware and cut a hole out of it and stick it on my blow dryer and not pay interest on it. Like, you want to think about that. Like, is this worth paying interest on? That is what will help curb your impulse buying. Do I really want to pay interest on this? Do I really want to pay more for this than they're already charging me? Yeah.
What if you don't have a credit card and you're still impulse buying? What's a word of advice you can give?
You don't have to carry cash. This is a good thing, especially if you're traveling. Because if somebody steals your cash, you're out of luck, right? Because it's cash. You have no record. Like you could be like, I had $100 in here, and they'll say, and I'll be like, give me back I need $100, and the bank is gonna be like, whatever. But if your card gets stolen, they cancel it and send you a new one. So you're not out anything. Um, it can, not necessarily does, but can increase your FICO score. There are factors there we'll talk about. You get a record of all of your spending. You can look at your credit card history back, probably years online now. Now, these are not individual. So, like, if I go and I buy stuff at, I don't know, Sears or something, I get a record that says Sears $150. I don't know, like, the individual things I bought at Sears necessarily. Some credit card companies do itemize individually, but some don't, so it just sort of depends on the company. Some of them have reward programs, like frequent flyer miles, gas rewards. I know my Exxon card, if I buy more than 45 gallons in a month, I get retroactively 6 cents off per gallon. Which, in the days when gas is ridiculously close to 4. Yeah, so I spend the money. Like I buy the 45 gallons worth of gas in the month at 3 whatever they are charging. Then they go back and they credit my account for 6 cents per gallon. So it comes off the gas I've already purchased. So, but some of them have, programs like that, and some of them you earn free gas, some of them you earn flyer miles, some of them you earn cashback rewards, and there's all kinds of different stuff like that. And then some insure your purchases.
So what credit card does like the gas ones?
I have no. Okay. So like some of the gas stations have reward programs, like the one I just told you, where you get
Okay, so you have to
pennies off the gallon, so you'd have to go through the gas station. But then some of the other major credit cards, you earn free gas. And there are so many different cards and so many different programs. I could not even begin to tell you who does what, because like Capital One Bank has a whole bunch of different types of credit card. It's like there's multiple ones. So you just have to do your research. Well, yeah, but Capital One has 7 or 8 different programs. Like, they might be more than that. I don't know. But there's, and some have different rewards, and you'd have to like do your research to look up. Yeah. Now, disadvantages. Okay, you end up paying more for the items you purchase because of the interest. The only way you get around this is if you pay off the balance every month. So if you charge $100 that month, you have to pay it off and not have the balance carried forward. That's the only way you get away from paying interest, which is what I do with my gas card, which I'll explain how I use that. Possibly a lot more. You remember from the movie, they were saying for every dollar that they were charging in principal, $2 were being charged in interest. So for those people, they were paying double, actually triple. Yeah. Now, the interest rate that you're being charged is not 200%, but depending on how long you carry the balance, you could probably pay more than that. Just depends, So you could end up possibly paying a lot more for things than they're worth, which is why I mentioned earlier, don't pay interest on things like fast food. Just don't. Nobody wants to pay $27 for a hamburger. And if it is a $27 hamburger, it better be from like some super fancy gourmet, Chef Ramsay kitchen or something, not McDonald's hamburger. Okay. You can wreck your FICO score. Now, I'm not saying you will. I'm just saying it's possible. Credit card companies are the quickest to report negative on your credit. Um, so, you're late, they report it. That lowers your FICO score. So they're the quickest. Other people give you more of a buffer. Credit card companies are really fast about it. So they can increase your FICO score, but they can also lower or wreck it. Yeah, well, yes, they can raise your interest. They can raise your interest at any time. All they have to do is give you like a 30-day notification, and they can change your interest rate to whatever they want. Also, on the reward programs. Most of the rewards that you earn cost less than the interest that you paid to get there. It's like the cranes at the arcade. Yeah, you might win that little teddy bear. After you spend $15 in quarters to buy a teddy bear you could have gotten at the dollar store for $1. Right? It's kind of like that. You get the rewards, and the rewards are cool. You get frequent flyer miles. But you have to spend so much money before you get a frequent flyer mile. They're getting discounted rates from the airlines and stuff, so you've actually paid more in interest than they're paying for your trip, and probably paying more in interest than you'd have paid to just buy tickets. After you talk about like the closeout dates and stuff like that, and you wouldn't, you could shop around and get cheaper tickets around those dates anyway. So free gas, you've probably paid way more in interest than a couple gallons of gas. You know what I mean? So yes, you get these rewards, but you're paying for them. Most common type of credit card is called a revolving charge account. And it's revolving because you can revolve the debt, like from month to month to month. You have a set maximum, but you don't have to pay off your balance every month. You carry it over, and you can have a balance of anything between 0 and your maximum at any given time. Once you hit your maximum, you pay it down, you can charge more. Just kind of, it revolves. It goes all over the place. You have a minimum monthly payment that you have to make. Generally speaking, the minimum monthly payment will not pay it off in any kind of short amount of time. If you max them out, even if you only max out 300, it can take several years to pay it off, paying the minimum monthly balance. The minimum monthly payment for most cards, it's a set fee or a percent, whichever is greater. So if it's, let's say they do a 10% is the minimum payment, or a $25 fee. So like if your 10% is less than $25, they charge the 25. If your 10% is more than 25, then they would charge whatever that 10% is. That's how most of them do it. Not all of them, but the majority of them do it that way. You pay finance charges. Okay, the way they calculate the finance charge. If you pay off the whole balance at the end of the month, like you pay the whole thing and you don't carry a balance forward to the next month, there are no interest charges. You don't pay anything extra. All the revolving ones. So most of the credit cards. So if you pay it off at the end of the month, you pay no interest. However, if you carry even so much as $1 forward, then they take your average daily balance of the following month and charge you the interest on that. So let's say okay, September's about to end, right? Okay, let's say I get my credit card bill for September and I pay it all off except for the $1. And then October happens and I charge a whole bunch of stuff in October. I'm going to pay interest on everything I charged in October because of that $1 I carried over. If I hadn't carried that $1 over, then I wouldn't pay the interest. Does that make sense? Yeah. You can stretch out your payments. Like if you need to buy something or your car breaks down and you can't afford to fix it outright, you can make payments on it. You can stretch them out, but your interest is very high. Like I said on the other page, the 20 to 30% on average interest on these. So, you have to determine if, like I said, if the thing that you're about to buy on the credit card is worth paying that interest on.
Okay, so if I remember correctly, you said that if that's the case, where if something happens and you have to charge it and you don't pay it all front, like when the payment is due, that it takes a while to catch up?
Well, it depends on if you're paying just the bare minimum, if you're only paying the minimum balance, it can take several years to pay it off.
Right, so like your minimum balance is like
Or the minimum payment.
$500.
Well, okay, let's say you have a $300 credit card.
Mm-hmm.
Your minimum payment's probably going to be about $25
A month.
a month. And paying $25 a month on a $300 balance could take you 2.5 years. And if you're paying $25 a month for a year, let's see, that's what, $300 in 1 year. But if it takes 2.5 years, you're paying somewhere between $600 and $900 for that $300, on top of.
Right.
So like I said, you can stretch it out if you need to, but your interest is high. So paying the minimum balance will stretch it out, but it can take a long time to pay it off, so you pay a lot of interest.
Right.
If you can pay it off in a shorter amount of time, let's say you have to charge $300 to fix your car and you can pay $100, $100, and you pay it off in 3 months,
Right. Okay. So
your interest is not paying as much. Yeah. Do you see what I mean? So the faster you pay it off, the less interest you end up paying because you're not carrying it forward so long. Because they don't charge like you spend $300 and they charge you some set amount of interest on that $300. They charge you interest every single month. So the longer you carry it forward, you're getting charged the same $300. You make the minimum payment, you get charged interest on $300, right? And then the next month you've brought the balance down to $290. You get charged interest on $290. That means you've been charged interest on the $290 from the first month, and then the $10. Then you get charged interest on the same $290. You've been charged interest on that same amount of money twice. Then the next month you're charged interest again on the same original money you borrowed.
Right.
So you're charged interest every single month until you pay it off.
Right.
So that original money that you borrowed, you could be charged interest on it. If it takes 3 years to pay it off, you're charged interest on it 36 times.
Yeah.
Granted it's a smaller amount each time, but that last $10 that you're paying has been charged interest 36 times.
Which adds up.
Yeah. So,
Right.
that's why I said you want to think about, is this worth paying interest on? Even if you have the best intentions, I'm going to charge this right now and I'm going to pay it off in a month and I'm not going to be charged interest, but then maybe something happens. You want to make sure, is this something I'm willing to pay interest on?
How long did it last you?
Okay, charge card. Okay, revolving charge account, Visa, MasterCard, Discover. Most of the major store cards, JCPenney, Sears, Target, gas cards, the majority of the cards out there. The charge card is a special card that you can only make purchases at stores that accept it, first of all. And then the monthly bill must be paid in full every month, and the first one that comes to mind is American Express. American Express is not a credit card, it's a charge card. And there's a difference between the credit card and the charge card. The credit card has revolving balances, and you can carry them forward. The charge card, you have to pay it in full every month. Another one that's probably not around all that much anymore is like called Diners Club, and it was only accepted at certain restaurants. Um, and there are probably other ones. I just don't know them all because there's a lot out there and you can't keep track of everything. But the way it works is if you pay it in full every month, you get charged no interest. It's great. However, if you don't pay it in full, there's high interest and fees. So, and most American Express accounts have really high balances, but you have to pay it off in full. Yeah.
Yeah, this is a question about the credit card. Because I just thought of it. Now, what if you, first of all, can you pay bills with it?
Hmm?
Yeah? Okay. So, let's say you owe like $400 for your water bill or something, which is
Hmm.
really high, but anyway, and then you charge that to it, and then they pay, and then you pay it, whatever, with the credit card, and then you can only pay each month, like, let's say you can only pay like $200 or $300, and then the rest of it you have to pay in interest, and you have to pay it off, right? But
Uh-huh.
what if each month you can only afford to pay $200 to $300, and each month you owe more and more money? Does it build up
Yeah,
some
it builds up.
interest, or do you just pay that minimum balance each month still? It just builds up.
Okay,
Does
so
it pay
what'll
it off
happen
in the long run?
is, okay, so, right, and talk at the same time. Truth in Lending Act protects you from, protects you if your card is lost or stolen. Okay. You have to notify immediately. And you are responsible So the way it works is if I notify them right away, like so I had my credit card on my way to work and then when I leave work it's gone. And so I call them and tell them and I report it stolen or lost or whatever. If no one has charged anything, then I don't owe any money. Like they cancel it and you're good. If somebody charges something before you notify them, they can charge you up to $50 of it.
Even if it's like $300,
Yeah,
you're gonna have to pay
but the
50?
50 is the maximum on that.
Okay.
But the way it works is they have to have charged it before you notified them. If I called them right now and I notified them and there hadn't been any charges and then 2 hours from now somebody charges on it, I'm not responsible for that because I told them. I'm only responsible if somebody charged before I told them and only up to $50. And that's on credit cards. Yeah.
So that's like if you're looking at your statement and then you see like something you didn't purchase and you call them and say,
That's different. This is if you're reporting the card lost or stolen. If you still actually physically have the card and you have fraudulent charges, that's a different process. And there has to be an investigation and all kinds of stuff like that. The Fair Credit Billing Act is kind of where you are with that. That protects against,
Fraudulent.
well, not fraudulent, errors. It protects against errors. And that can be calculation errors or it can be charges that you didn't do. So this is the act that would protect in that case, and there's going to be an investigation. And it could be a simple investigation where they redo the math and go, oh yeah, 10% of 300 isn't 5,000. You're right. Or it could be because there's a charge on there that wasn't yours, then they do an investigation to determine how that happened. So that's a little different than this. This is with a lost or stolen card. This is with errors on the statement. Your debit card. Directly out of bank account. Like a check. You don't pay interest on your debit card. right? No interest. Um, and the Electronic Funds Transfer Act, does yours have the word transfer in there? Because mine disappeared. It's the Electronic Funds Transfer Act. This is the one that protects from unauthorized use of cards. And you owe no money. Okay, so if somebody gets a hold of your debit card and charges a bunch of stuff on it, whether you reported it in time or not, you don't owe. It's only on the credit card that if they charge before you report it, you owe $50. That's up to $50. The credit card company does not have to charge you that $50, but they're allowed to charge you up to $50. With the debit cards, the banks are not allowed to charge you anything. Now, they will generally conduct an investigation before they credit the money back to your account, or sometimes they'll credit the money back to your account pending. So they'll say, like, we're going to put the money back in your account, but if after the investigation shows that that wasn't an unauthorized charge, then we're going to take back out, kind of thing. And then the Fair Debt Collection Act is that they cannot harass you at work. Yeah, just write it at the bottom. And they cannot use unfair means. Now, they can annoy you at home. However, they cannot go to your neighborhood and put flyers of you up all over your neighborhood and be like, oh, doesn't pay their debts. They can't do that. They can't go to all your neighbors and say, hey, tell this guy to pay his debts. They can call you all the time, but they cannot harass you at work. If they call you at work and you tell them, this is my place of employment, you are not allowed to call me here, they cannot call you there again. If they do, you can file complaints against them. You have grounds. And all kinds of stuff can happen.
So if they call your house and you tell them this is my place of business.
No, it has to be your place of business.
Even if it's not and you tell them it is, if they call you again?
No, it has to actually be your place of business, yeah. It has to be your actual employer. And it can't be